Ever wondered how to make your money work for you? Curious about the secrets behind building lasting wealth and financial security? Well, you're in the right place. Welcome to our YouTube channel, where we embark on an enlightening journey into the world of wise investing and financial prudence. Have you ever asked yourself, how can I invest wisely and build wealth with confidence? If so, you're about to discover the answers. Join us as we explore essential topics such as understanding investment basics, creating a solid financial plan, implementing smart investment strategies, building a diverse investment portfolio, avoiding common pitfalls, and mastering the art of long-term wealth management. Get ready to unlock the secrets to financial success and secure your future. Please subscribe to the channel and let's dive in. 1. Understanding investment basics. Investing is a fundamental pillar of financial growth, but it's essential to grasp the basics before diving in. Different types of investments offer varying levels of risk and return. Stocks, for instance, represent ownership in a company and can yield significant returns over time, but they come with higher volatility. Bonds, on the other hand, are debt securities where investors lend money to an entity, typically a corporation or government, in exchange for periodic interest payments and the return of the bond's face value when it matures. Bonds are generally considered safer than stocks, but offer lower potential returns. Understanding the concept of risk and return is crucial. Generally, investments with higher potential returns also carry higher risks. It's vital for investors to assess their risk tolerance, which refers to their ability and willingness to withstand fluctuations in the value of their investments. A well-balanced investment portfolio considers an individual's risk tolerance, ensuring that it aligns with their financial goals. Diversification is another key principle. Spreading investments across different asset classes and geographic regions can help reduce risk. If one sector or market performs poorly, gains in other areas can offset potential losses. Diversification isn't limited to stocks. It extends to bonds, real estate, and other investment instruments. By diversifying, investors can achieve a balance between risk and potential rewards. 2. Creating a creating a solid financial plan is the cornerstone of successful investing. It begins with setting clear and achievable financial goals. Short-term goals might include building an emergency fund or saving for a vacation, while medium-term goals could involve purchasing a home or funding a child's education. Long-term goals often revolve around retirement planning, ensuring a comfortable life during one's later years. Budgeting and saving are essential components of any financial plan. Tracking income and expenses helps individuals understand their financial habits and identify areas where they can save. Creating a budget allows for disciplined spending, ensuring that there's money left over for savings and investments. Emergency funds act as a safety net, providing financial security during unexpected events like medical emergencies or job loss. Financial experts often recommend having 3 to 6 months' worth of living expenses saved in an easily accessible account. Having a financial plan also involves understanding the power of compounding interest. By starting to save and invest early, individuals can benefit from the compounding effect, where the interest earned on their investments earns additional interest over time. This compounding can significantly enhance the growth of their savings and investments. In the realm of investing, understanding one's risk tolerance and financial goals is paramount. A well-thought-out financial plan not only provides direction, but also ensures that investments are aligned with an individual's aspirations and capacity to bear risk. Together, these elements form the foundation upon which a secure and prosperous financial future can be built. 3. Smart investment strategies. One of the smart investment strategies that investors often employ is dollar cost averaging (DCA). DCA involves investing a fixed amount of money at regular intervals, regardless of market conditions. By doing so, investors buy more shares when prices are low and fewer shares when prices are high. This approach helps mitigate the impact of market volatility on investments over time. It instills discipline, preventing investors from making impulsive decisions based on short-term market fluctuations. Another crucial consideration is the choice between value investing and growth investing. Value investing focuses on identifying undervalued stocks or assets trading below their intrinsic value. Investors following this strategy believe that the market has undervalued these assets, and their prices will eventually rise. Growth investing, on the other hand, emphasizes investing in companies with strong growth potential, even if their current valuations seem high. These companies typically reinvest their earnings to fuel expansion and innovation, potentially leading to substantial capital appreciation. Tax-efficient investing is a vital strategy to maximize returns. It involves minimizing the tax impact on investment gains by utilizing tax-advantaged accounts like individual retirement accounts (IRAs) and 401k plans in the United States. These accounts offer tax benefits, allowing investments to grow tax-deferred or tax-free, depending on the account type. Additionally, investors can optimize their investment portfolio by considering tax-efficient funds and holding investments for the long term, which often results in lower capital gains taxes. 4. Building a diverse investment portfolio. Asset allocation plays a pivotal role in building a diverse investment portfolio. It involves distributing investments across different asset classes, such as stocks, bonds, real estate, and commodities, based on an investor's risk tolerance and financial goals. A balanced asset allocation can help optimize returns while managing risk effectively. For example, younger investors with a longer time horizon and higher risk tolerance might allocate a larger portion of their portfolio to stocks, which historically offer higher returns over the long term. In contrast, those closer to retirement might shift their allocation towards more stable investments like bonds to preserve capital. Real estate investments can provide both income and potential appreciation. Investors can choose between residential, commercial, or rental properties based on their preferences and financial objectives. Real estate often acts as a hedge against inflation and can offer a steady income stream through rentals. Exploring alternative investments is another strategy for diversification. Alternative investments include assets like cryptocurrencies, commodities, and peer-to-peer lending platforms. While these investments can be more volatile and carry higher risks, they can also offer unique opportunities for substantial returns. It's crucial for investors to thoroughly research and understand these alternative assets before incorporating them into their portfolio to mitigate potential risks. Diversifying across various sectors and geographies within each asset class further enhances portfolio diversification. By spreading investments across different industries and regions, investors reduce the impact of adverse events in any single sector or market, ensuring a more resilient and balanced investment portfolio. 5. Avoiding common investment pitfalls. One of the most common pitfalls investors face is the temptation of market timing. Trying to predict short-term market movements and making investment decisions based on these predictions often leads to poor outcomes. The market is inherently unpredictable, and attempting to time it can result in missed opportunities and unnecessary losses. Instead, a prudent approach involves staying invested for the long term, focusing on the overall performance of the investment portfolio rather than short-term fluctuations. Emotional investing is another significant challenge. Emotions, such as fear and greed, can cloud judgment and lead to impulsive decisions. For instance, fear during market downturns might prompt investors to sell their investments at a loss, locking in losses instead of riding out the market's natural fluctuations. Conversely, greed can lead to excessive risk-taking, ignoring fundamental principles and increasing exposure to high-risk assets. Overcoming emotional biases requires discipline, well-defined investment strategy, and a focus on the long-term financial goals. Understanding fees and charges associated with investments is essential to maximizing returns. Different investment products come with various fees, such as management fees, brokerage commissions, and administrative costs. These fees can erode a significant portion of the returns over time, especially in the case of actively managed funds. Investors should carefully evaluate the fee structure of their investments and opt for low-cost, passively managed funds such as index funds and ETFs where possible, allowing them to keep more of their returns. 6. Long-term wealth management. Retirement planning is a critical aspect of long-term wealth management. As life expectancy increases, ensuring a financially secure retirement has become more challenging. Individuals need to estimate their retirement expenses, including healthcare, housing, and daily living costs, and plan their savings and investments accordingly. Retirement accounts like 401ks, IRAs, and pension plans can play a crucial role in building a retirement nest egg. Regular contributions, combined with the power of compounding, can significantly grow retirement savings over time. Estate planning is often overlooked, but is essential for preserving wealth for future generations. It involves creating a will, establishing trusts, and designating beneficiaries. For assets like life insurance policies and retirement accounts, proper estate planning ensures that assets are distributed according to the individual's wishes, minimizes tax liabilities, and provides financial security for heirs. Financial markets evolve, and economic conditions change. Staying informed about market trends, economic indicators, and investment strategies allows investors to make informed decisions. Regularly reviewing and rebalancing the investment portfolio based on changing market conditions and life events ensures that the portfolio remains aligned with the investor's financial goals and risk tolerance. In summary, avoiding common pitfalls, planning for retirement, and staying informed about financial matters are crucial components of long-term wealth management. By adopting a disciplined and informed approach, investors can navigate the complexities of the financial world and work towards building and preserving wealth over the long term. If you enjoyed this video and found the information helpful, please consider liking, sharing, and subscribing to our channel. By doing so, you'll stay updated with our latest videos packed with expert tips and strategies to help you make informed financial decisions. We encourage you to share your thoughts and questions in the comments section below. Your feedback is invaluable, and we're here to support you on your financial journey. Don't forget to hit the notification bell to stay notified about our upcoming videos. Thank you for joining us today. We wish you all the best on your path to financial prosperity and look forward to seeing you in our future videos. Until next time, stay financially savvy and invest wisely.